In a move that has sent shockwaves through Indian markets, the US administration announced a staggering 100% tariff on imported branded and patented pharmaceuticals. At its core, the problem is India's heavy reliance on the US for generic exports, a dependency built on cost efficiencies, but it's now vulnerable to protectionist policies of the US. The scale of this impact hits hard. $10.5 billion in US bound shipments represent 35% of India's FY25 pharma exports. And analysts anticipate an elevated risk of further hardening of tariffs to include generic drugs, which could inflate EBITDA swings for all Indian drug manufacturers. At Hedgonomist, we arm you with data driven insights. Sudden market news can unleash wild swings, tempting you to chase profits or jump ship. But rash moves often falter without a deep dive. Think of knowledge as your hedge. Today, we tackle Indian pharma's US tariff storm with bold clarity. India's pharmaceutical sector is a $55 billion global generics leader, ranking third by volume. The United States absorbs almost 35% of India's exports, reflecting a robust 10% year on year growth. Indian Pharma, the US BRICS Hedge Index (IPUBHI), tracks this exposure and also serves as a real-time volatility radar. As per the stats, Sun Pharma and Dr. Reddy's depend at 31 and 45% of their revenue from US tenders, respectively, underscoring deep market reliance. The export mix splits sharply: 90% generics versus 10% specialized products, all built on a 30 to 50% cost advantage over US production. Risks for the pharma sector, meanwhile, stack up with measurable conviction. Increased FDA audits in 2025 contributed to volatility. Supply chain exposure adds another layer. With 65 to 70% of active ingredients sourced from China, it amplifies geopolitical risks. Historical precedent also gives us an insight into the volatility. In 2019, FDA's import alert triggered an export disruption. The pharma index almost dipped 2% in recent days, and yet it has signaled a quick mean reversion in generics. Unfortunately, for investors who are heavily positioned in Sun Pharma or Dr. Reddy's, stand to lose in the near term, as the current tariff situation targets their specialized segments, potentially eroding 5 to 10% of short-term valuations amid market jitters. If you are thinking of adding positions to these stocks, consider waiting. While India's policymakers have been preparing for such trade headwinds since 2024, let's divide this in three stages and discuss them for clarity. Pre-tariff preparations 2024 to early 2025. Indian government's revival of the production-linked incentive scheme in early 2025 injected $2.5 billion in domestic API parks. It's a deliberate push for self-reliance amid global trade tensions. In April 2025, the US-India Trade Policy Forum secured a carve-out for essential medicines, shielding generics from broader duties, thus ensuring that the generic drugs are exempt from these tariff situations. Post-tariff geopolitical lifelines. In last 72 hours, China delivered a game-changing geopolitical shift. On September 28, China slashed its 30% import duty on Indian pharmaceuticals to zero, making it a second rescue act. This timely move unlocks $2 to $3 billion in opportunities for Indian exporters, rerouting 10 to 15% of the US bound volumes into China's $150 billion market. And the markets roared back. And now to the final part 3 of this whole preparation. India's strength is now fueling a smart plan to sell more drugs to the BRICS countries, Brazil, Russia, China, and South Africa, to depend less on the US. These nations together could have a $10 trillion trade by 2030, and India is jumping in with new trade deals starting in 2024 and 2025. China has already opened its $150 billion market with the immediate $2 to $3 billion boost for Indian generics. Russia has offered a $1 billion new drug deal. Brazil's health program could buy up to $1.5 billion worth of drugs from India. And South Africa has added $500 million through African herd hubs. India's exports aims for $5 to $7 billion in BRICS sales by FY27, shifting 15% of its drug exports in just 1 year. For investors, this is a chance. Buy India Russia stock funds or bet on Indian firms like CIPLA or LUPIN. Even if US tariff gets tougher, the current backup plan means no substantial long term threat. In fact, treating short term volatility is your alpha window as of now. Thanks for tuning in. And if you like this breakdown, like and subscribe for more or check our other videos as well.